So we've tangentially mentioned a lot of these types of commercial real estate financing options, but let's just explicitly go through them. So there's the traditional term loan. Okay, so this is the type of loan that a bank would offer to a investor of commercial real estate to finance their purchase or refinance an existing loan. So these are loans that are coming from banks most typically. There are also specialty kind of uh, commercial real estate finance companies that will originate these term loans. And as the name implies, term loan is going to be maturing after some amount of time. So there could be a 5 year, 7 year, 10 year. Beyond 10 years is a little less, much less common. Um, but for commercial loans, we're kind of used to 15-year and 30-year mortgages for residential real estate, but in commercial real estate, since there's no big government kind of subsidy like there is for residential real estate, these loans are typically much more shorter term. But there are 10-year kind of commercial real estate loans available. And there are longer term, but you're probably going to pay a much higher interest rate and they're going to be harder to come by. Commercial mortgage-backed securities. So this is a way of kind of getting capital into commercial real estate. For the borrower, it's essentially going to be a term loan, but it's really a question of where the capital is coming from. So with the traditional term loans, a bank will give a borrower a loan, and then the bank is just going to hold that loan and collect the interest and the payments for the 5, 7, or 10 years or however long the loan is outstanding. And the bank is the source of capital for that loan. Commercial mortgage-backed security, again, to the borrower is going to look the same. They're going to have a 5 year, a 6 year, 8 year, 10 year uh, loan that's also secured against the real estate, just like any other mortgage. But the financing is coming from the capital markets, and so in the next slide here, I'm going to show you how that works. But basically, the commercial mortgage-backed security market is a way that the capital markets are going to play a role in the financing of commercial real estate. Construction financing. So the last two kinds of loans we talked about are more for existing properties. So like if you find an office building that you want to buy, you're gonna get the financing lined up. To build new commercial property, you're gonna get construction financing. So the difference between the two is that construction financing is kind of paid out as the construction process proceeds. The bank will not just give you all the money up front for the construction. They're gonna release the capital um, at different points in time during the construction process because they want to make sure that they don't just give you a big lump sum and the money just doesn't kind of uh, get the project done, and they're stuck with this kind of half complete project and the builder has run out of money. So they're only going to release the money at certain milestones. So after a particular inspection, you're going to have a kind of construction schedule, and there's going to be draws on the loan as you progress. So maybe you'll have to pass the foundation inspection, and then at that point, the bank will give you more money, and then you got to do the framing inspection, and then the bank will give you a little more money. So that's kind of how construction financing works, and it's typically a higher interest rate because the bank is taking a bigger risk. They're kind of giving a loan against something that doesn't yet exist, and so they're going to charge a higher rate of interest to compensate them for that risk. Typically, the construction financing will be shorter term, maybe a couple years. And by then, you would expect that the construction is done. And usually the bank that gives you, or I wouldn't say usually, I would say oftentimes, or it's not uncommon for the bank that gives you the construction financing to basically pre-negotiate the takeout financing, meaning at the end of the 2 years of the construction loan, they will have already kind of prearranged to be the lender to put in a term loan. Essentially, they'll give you kind of a longer term uh, loan to kind of pay off the construction loan and then have a longer term loan in place because by the end of the construction there's a finished product, and so a lot of the risk has been taken out, and so the bank would then be willing to lend on a longer term basis and a lower interest rate, because the thing now exists and hopefully is operational and producing income. So that's what takeout financing is. A bridge loan is similar to a term loan in that there's going to be some stated interest, and it's going to be for some term, but the term is going to typically be shorter. Another difference is that the bridge loan is more flexible in terms of the underwriting. They may allow you, if you're gonna, for example, renovate a property, they'll give you some of that kind of extra money that you'll need to finance the rehab. And um, and so typically, they're a little more flexible. Bridge lenders are going to be a little more opportunistic and have more flexible and kind of business oriented underwriting standards. The trade-off is that they're probably going to charge you a higher rate of interest, and the term is going to be shorter. So it may be, 2, 3 years, and maybe they're going to charge you for extension options if you want to have the loan out for longer than that. Because the expectation of the bridge lender is that you're going to buy the property because maybe you needed the bridge loan because you needed the money quickly, and maybe the property is in distress, meaning that it's not necessarily generating the income up to its full potential. Maybe the occupancy is low, etc. So the bridge lender will come in, uh, give the loan to the borrower, and then the borrower is going to then, reposition the property, meaning they're going to rehab it, they're going to get the occupancy up, and then the eventual goal is to trade out into a longer term traditional term loan, and pay off the bridge loan. So the bridge loan, as the name implies, is kind of a bridge between the acquisition to getting a longer term, lower rate of interest mortgage in place. And then finally, there's mezzanine financing. This is uh, kind of a blend, or it sits between a mortgage, like a traditional loan, and the investor equity. Okay, so if you have what's called a capital stack, okay, so let's say you needed $10 million to finance a purchase of a property, maybe 60% of that, so 6 million, is going to come from a loan. Okay, this is from a mortgage. Now, without any mezzanine financing, you'll have to bring $4 million here as equity to fill out the rest of this capital stack to get to 10 million. You need 4 million. Now, mezzanine financing is going to be kind of a middle. Okay, it's potentially a way that you can finance some part of this equity. So you could add a little layer here of mezz financing. So let's say you had $2 million, or yeah, let's say 2 million in mezz. That means you only have to come up with 2 million of owner equity. Okay, and so the mezzanine part of it will be kind of like debt in that you'll pay some rate of interest. It'll be higher than the loan because really this lender here is taking the least risk, because if something happens in this, you can't execute on the property, they're just going to foreclose and collect their money, and they have this $10 million property to collect. So this mezzanine lender is the next in line. They would be next to collect, but they're still not as senior as this loan. Okay, so they're taking uh, a little more risk than the mortgage lender, and so they're going to be compensated in interest accordingly. And oftentimes, that mezzanine financing will also have some level of participation in like the upside of, like, if the property does really well, the mezzanine lender will also make a little extra. Okay, so it's a way basically to reduce the amount of equity that a owner has to bring. Okay, and this has kind of couple of effects on the owner. One, they don't have to raise as much money. Okay, they can basically control this $10 million asset with only putting up $2 million of their own money as opposed to 4 million. So they you have to put up less money to control this asset. It's more risky though because if this thing if this property kind of declines in value to 8 million, then this equity is going to disappear 100%. They're going to take the first loss. The mezzanine and the mortgage lender will collect their money, but your equity will get wiped out. If you had put up 4 million and not had the mezzanine, then even if it declined to 8, you would have went from you still would have lost, $2 million, but you've only would have lost 50% of the equity. Okay, so as a percentage, you would have lost 100% in the case that you took the mez, sorry, 100%, versus if you didn't, you would have lost only 50%. So in terms of percentage loss, the mezzanine debt is going to kind of amplify the potential for you to lose equity. But of course, if things go well, with that $2 million, you could make a much larger percent return if things go well and you use mezzanine financing. So this is why this idea of leverage, it cuts both ways. It can enhance returns, but it can also enhance losses by borrowing more. But oftentimes, if it's a very large deal or the equity kind of the person who's kind of trying to buy the property is having trouble raising the equity capital to do it, they may ask a mezzanine lender to come in and kind of fill some of that gap in this what's called the capital stack here.